Welcome to the Trade Smart series here on TCM. Let's discuss one of the most unlikely scenarios for investors and swing traders. Obviously, this chart does not apply at all, or this instrument does not apply at all to day traders, but swing traders, not to mention investors, had a huge surprise on their hand, obviously looking at this unbelievable scenario. So in early June or late May, the XME, which is the Spider S&P Metal and Mining ETF, broke then the highs of the year. It was 60 on a cup and handle formation. The risk was $2. $2 out of 60, that's less than 4%. Let's call it 4%. So the risk was 4% on a trade on the daily chart. That's very, very little risk. But let's ignore the part of the risk because nothing basically was applicable on the risk side. The question is only how do you manage the upside? Now, how many of you, including the most optimistic, would have said, okay, we're going to see it closing on 100 in the next 3 or 4 months. So it's not at 100 yet, but this is, guys, a 50% move in 9 weeks. 50%. Now that's better than Nvidia, that's better than Palantir, maybe very few stocks like Oklo and Robinhood delivered way better returns, but take a look at the risk. The risk is what counts here, and the risk on this entry here at 60 was 4%. So if you go from 4 to 50, it's clearly 10 to 1. Now, obviously, nobody expected 10 to 1, but let's say you are in the trade, okay? What do you do? Okay, so one thing that you can do, you can elevate the stop loss. Now maybe to 80. I mean, it's at 89, so you leave a 10% pullback on the table. Now, any pullback has been so far very, very successful, so the pullbacks are clearly stop losses. I would have to say that if anybody is in that 60 plus amazing trade, the stop loss should be now at 80, and this one is already at the moon. Okay guys, see you in the next video. Please like and subscribe, and thank you for that.